Good morning, welcome to the ADS Securities Markets Update. Beginning with the Asian session, as always, there were a few economic releases and events and key events which had a notable impact on the markets. Beginning, or the main focus basically was on the People's Bank of China, who surprised the markets again today with cutting the 14 days repo rate toward 3.2% down from 3.4%. And this is not the first time that the bank also cut the repo rate again this month. A few days ago, the People's Bank of China also surprised the market by cutting the main rate, and ADS Securities noted on November 10th that on Al Arabiya TV that the People's Bank of China will no longer be able to expand its asset or its QE and likely to cut the reserve requirement ratio or the main rate. In the meantime, and with discontinuous measures in a very short period of time, it shows that the central bank is worried about the growth outlook, and it's almost the same as what happened with the Bank of Japan or in Japan a few weeks ago, when the Bank of Japan surprised the market with an additional 20 trillion yen in QE a few days after the Federal Reserve ended the third round of QE and few days before the GDP figures, which confirmed a triple-dip recession in Japan. The Bank of Japan monetary policy meeting minutes also came in with no big changes, and while the Bank of Japan governor noted that the bank will be watching the FX move very carefully and will add more stimulus if needed. In New Zealand, the inflation expectation for the upcoming quarter for QE4 or Q4 came in or declined back toward 2.1%, down from 2.2% in previous quarter, and matching the lowest level since the second quarter of last year. As for the Asian currencies today, the Kiwi and the Aussie recovered some of their losses at the beginning of the session on the back of the People's Bank of China decision today. However, the Japanese yen remains notably higher against both against both currencies. The AUD JPY fell by 0.6%, while the NZD or the Kiwi yen tumbled by 0.67 until this report is released. As for the European session today, few economic figures will be released from Germany, Italy, and the UK, which may have a slight impact on the markets, while the main focus will be on the Bank of England later today. Beginning with Germany, the final GDP is expected to remain unrevised at 0.1% in the third quarter of this year, and in Italy, the retail sales is expected to rise by 0.2% in September, comparing to a decline of 0.1% in August, which would be also the first monthly increase since about 4 months. In the UK, the the BBL mortgage approvals is expected to decline further toward 38.5 thousand in October, down from 39.3 thousand in September, which would be the fourth monthly decline in a row and the lowest reading since the beginning of this year. The main focus today in this session will be on the Bank of England inflation reports hearing, which will be held at around 10 GMT time this morning. Going forward to the US session today, we'll be waiting for a collection of economic releases from the US and Canada, which likely to have the biggest impact on the market during that session. Beginning with Canada, the retail sales is expected to rise by 0.6%, while the core retail sales may rise by 0.4% during the month of September, and this is after a decline of 2 consecutive months. In the US, the Q3 GDP is expected to be revised down again toward 3.3, down from 3.5, sorry. However, the revision may come in more than expected toward 3% or below that on the back of the rise in the deficit or the trade deficit with more than 7% in October, and in addition to that, the decline in the construction spending in addition to the consumer spending, which came in also worse than expected. However, the CB consumer confidence is expected to rise further toward 95.9 in November, up from 94.5 in October. And finally, the Richmond Fed Manufacturing Index is expected to decline towards 17 in November, down from a 20 in October, which would be the first monthly decline after 4 consecutive months of gains. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube to get the latest economic releases, reports, and analysis. Thank you for watching.